right. So we are talking about a category of investments called semi-liquid funds or semi-liquid investing. What does that mean? What are we're going to do a little bit of a SWOT analysis. What are the strengths and the weakness, the opportunities, and some of the threats when we talk about this area of investing? So Jeremiah, can you kind of define for our listeners, what do we mean when we say semi-liquid investments?
Yeah. So in finance, we talk about liquidity. We mean how quickly you can turn something into usable cash. And so on one extreme, you have your checking account, your savings account. That's very liquid. It's just as good as cash. It can be, the next day within 5 minutes, you can make it into cash. The other extreme, might be something like, we'll just say a house. You buy a house. You can turn it into cash. You can sell it, but you can't do it tomorrow. It might take you 30 days, might take you 60 days before you can actually get the house on the market, get it sold, have an escrow, have it close, and now you've turned that house into usable cash. And so there's a gamut of these ideas of liquidity. So when we talk about something being semi-liquid, it means that maybe you can get to some of it, but you can't get to all of it, or at least not without a lot of pain. And so, to answer, people
Mhm.
might be thinking, well, I could sell my house quickly. You could fire sell your house for half price and move it very quickly, but you're
Yep.
leaving a lot of value on the table. So how do you still get your reasonable fair value and turn it to cash? How fast could that be? So that idea is called liquidity.
Yeah. And it doesn't mean that you can't tie up some of your assets in illiquid investments or semi liquid investments, but we want to balance that with the liquidity that you do have. So we always talk from a simplistic perspective with every client that comes in the door. What cash do you have available? What's in your emergency fund? Because liquidity and cash flow is always critical.
Hmm.
Even if you're just preparing yourself for the next fantastic investment opportunity, what you don't want to have is sort of the well dry up, so to speak. So let's say, just for the sake of kind of exploring this topic, that we have a client who has ample in terms of cash flow and an emergency fund saved up. And so now, and they've got their retirement accounts. We would call those fairly illiquid, mainly because of the time horizon. They're meant for some time in
Hmm.
the future, right? So kind of this intermediary liquidity is the semi-liquid. And so if you had funds available for this, what are some opportunities? Let's talk about some strengths for semi-liquid investments.
Yeah. So one that we see a lot is a term called REITs. So real estate investment trusts. So usually what this is you think of maybe all the big high sky rises down in LA. You drive through downtown LA, you'll see all the different big buildings. Very few of those are currently owned by individuals. It used to be back in the day, but not any longer. So often it's a pooled account of a trust, basically, that many different investors have now purchased that large building. And you also could buy a REIT and you could have
Mhm.
an ownership interest in some of those big buildings. And often what the REITs receive is the rents. They receive that rent money coming back in. And so every month or every cycle, every quarter, you get some sort of a either dividend or a payout. And there's some other interesting aspects of why REITs are interesting. But
Mhm.
often some of the rules are with those is that they're not publicly traded on like the markets. So you can't just exit it tomorrow. Often there's some
Mhm.
sort of a window or period where you're allowed to get some of the money out or even a chunk of the money out, but often not all of it and often not today. And so
Mhm.
because of this, they call them either non-traded REITs or illiquid REITs or just REITs in general. It's
Mhm.
going to take you a little bit of time to get out. And we've had a number of clients who these have been very successful for. They get good exposure to great commercial real estate. They get great income. They get great growth. We've had others who kind of get stuck and
Right. And
they just can't.
I would say, sorry to interject there, I think that for those who do find a lot of value in these types of investments, they're interested in getting into real estate specifically. Maybe that's their industry or they're just interested in it. But when we talk through the criteria of being a property manager and the risk that they hold by holding one type of property, do they want residential or do they want commercial, right? If that is not, I always like to say, stay in your lane. If that's not the lane that you want to be a part of when you talk about owning real estate, then potentially an investment in a REIT could be another way to diversify your portfolio into real estate holdings without you having to take on that role of being a property manager.
Yeah. So it's a great benefit. And I think we've seen some really good benefits over the years from folks using these types of investment vehicles, but they're just a little different and they come with this liquidity. The biggest risk I would say is this liquidity risk. When do you need the money? How do you get it out? So for example, if somebody put 100% of their portfolio into one of these investments and then life changes. There's a job layoff, there's a pivot, and you need some of that cash unexpectedly. It's very difficult and sometimes very expensive to get that money back out. And so it's not
Mhm,
one that you'd want to put, all of your portfolio on, but some. So it's a,
mhm.
mid semi-liquid is the term Laura's using, a semi-liquid type investment.
I
Um,
would also say too, it could either be an opportunity or a threat if we're applying that SWOT analysis, but you need to think of a REIT and the manager of the REIT, or if it's a committee, just like you would investing in a mutual fund or an ETF, right?
mm,
So we evaluate a lot of the funds that we might invest our clients in based on different metrics for how that manager, we forget that there's actual manager who is picking the individual stocks or holdings that go inside of that ETF. Most people just think, oh, yeah, I want that ETF, like they're pulling a product off the shelf. But there is someone who has curated each individual holding that goes inside of that basket of funds, right? And so typically they're paid by the internal expense ratio of the actual fund itself. Well, REITs are similar. There's a manager who is picking and choosing and selling off the individual properties within that REIT. And so there's an added layer of evaluation to say what manager or committee is making those decisions for the REIT, and do you agree, and look at their track record, right? So there's some further
yeah.
evaluation for the REITs as well.
Yeah. A great example, 5 or 6 years ago, we were evaluating a REIT that kind of came in front of us, and what they would do is they would buy up basically these strip malls, mall type properties that were starting to struggle because of Amazon, because of these other, how retail was changing, and it wasn't so much that we believed in retail. The question was, do we believe in this management team's ability to acquire these assets somewhat inexpensively and then repurpose them in a way that was going to be meaningful, turning them into movie theaters or bowling alleys or things like that. We ended up choosing not to invest in it, but just as you said, Laura, the analysis wasn't necessarily on each property because there was hundreds throughout the country. It was more on the management team. Do we believe that they'll be able to be successful in what they're trying to do? So,
Yep. Yep.
yeah, it was a great analysis.
Well, there are so many, so let's go ahead and move on. Let's talk about this is a form, and I thought this was kind of an interesting application of this. But when we talk about semi liquid funds, I wanted to talk about restricted stock units, restricted stock options. So we have several clients that are high W 2 income earners, and there's a certain point where they might be incentivized for restricted stock units, or maybe they're joining kind of a startup or a new company, or it might be an established company. So it's a way that an employer can add benefit and compensation to the employee over time, and they want to incentivize retention. So there are different types of stock options that could be offered to employees. I'm just focusing right now on RSUs, which essentially has a vesting schedule attached to it. And so you hold stock, or you're gifted stock for the employer from the employer. And over time, that stock matures, and then you have the option to retain the stock or sell it and diversify. It's a semi liquid investment, but let's talk about some of the weaknesses or the threats around that one.
Yeah. So the nice part about these is, think of ice cream. It comes in so many flavors, right? These
Yes.
types of option plans come in so many different versions. So you really have to understand what your employer is offering. But to your comment, Laura, often there's a vesting schedule. If you're
Yep.
in tech, 4 years with a cliff, that's a very common type of structure. There's a lot of other vesting structures, but until the stock vests, it's not yours yet. And but there's value that's tied up. And so we've had a number of
Mhm.
clients who will say, "Hey, here's my vesting schedule. I'm almost unintentionally highly invested in this company. And if it does well, then 4 or 5 years from now, man, I'm going to be in a great spot. But between now and then, there's a lot of life. We've had clients that struggle financially, having kids, buying houses, trying to build their personal life. And they have all these restricted stock units sitting here that they can't access yet. And so even though they feel they make good income, that income is kind of locked in and it's not liquid that they
Mhm.
can't use it. And if the stock is doing really well, they just feel like they're getting more and more income off of these, even though they can't use it yet. They're just seeing the balances go up. We've had others where the stock really doesn't do much, or in fact even goes down. And so even though they feel like the compensation they got was at a certain level, because the company's stock is generally coming down for that season, they feel like they're watching their accounts slip away, and they don't have an
Mhm.
ability to diversify or change it. And so people who work for a company that offers stock options or restricted stock units, those RSUs, it's a wonderful piece of compensation. But there's a whole nother layer of liquidity going over that you don't necessarily have access to it. The other layer of that one specifically is taxes. Those are all
Tax
taxed in very,
planning.
yeah, very different ways of how those will be taxed, when they'll be taxed, and so we have to
Mhm.
have that overlay for someone's specific plan.
Yeah,
But the taxes and the access to the cash, wow, that's a really unique layer there. So anybody who
yeah.
works in that space, I always encourage them to have an advisor who can guide you through that, because there's a lot of, in my mind, really good value that could be added to your confidence in your future by understanding how your plan is going to affect and impact what you're building.
100%. Lots of strategy that can be at play to benefit you. I'm going to say one of the benefits of that vesting schedule is that you can anticipate the spike in income. You can anticipate, assuming that the stock has gone up in value, power of positive thinking, right? But you can anticipate a tax event, whether positive or negative, that you need to prepare for. And so I really enjoy having those conversations in preparation for those moments to try to minimize our tax liability, maximize the benefit to the couple, and still talk about, assuming it's a couple, but to the household, and talk about diversification. When's the right time to diversify that holding in a tax efficient way? So, all right,
Yeah,
let's see.
yeah, that's
What else
good.
should we talk about when we come to semi liquid? What's next on our list?
I think a fun one is IPOs, initial public offerings, when stocks are. So a big one in the news right now is SpaceX. SpaceX and
Hmm.
Starlink, which SpaceX owns, are both currently private, but there's discussions of SpaceX going public in an IPO, initial public offering. And there's rumors it might be over $1 trillion IPO. It could be an incredible thing. So people sometimes want to invest in that. Say, hey, I want to be the first one in, and so there's a version of this that the day that it goes public, it opens on the markets. It becomes a traded, just like Alphabet for the Google stocks, or Meta for Facebook, or any of those other stocks you can buy. So when it first goes public, it's the first time it becomes available. So you can just buy on the market that first day. Others say, no, no, I don't want to be there the first day. I want to be the day before. I want to be one of the people who get in there early. And it can be great, but often when you do an IPO, first you have to be qualified. There's a bunch of hoops to get through. But when you do purchase it before the public offering, or as part of that initial offering, often there's like a 6-month lockup. So that even
Nice.
if you are in, you got whatever the set price was, and they say go, and they go public, and then the price starts finding its own way, whether it goes up or it goes down initially. But a lot of people are locked in who, part of that IPO, they're locked in for a period of time, 3 months or 6 months. And so people don't always realize that investing on the complex side, where you're an accredited investor working directly through an investment bank, there's a lot of money that could be made. And there's a lot of people like to do this, but it becomes a non-liquid asset for a while. And
Mm,
it's
yeah.
hard for folks sometimes to watch the price, skyrocket and then come back down. So example could be Newsmax, that came out, I think, early 2025, kind of supported by Donald Trump as it came through. And it skyrocketed. It went way, way up. And then it came way, way down. And it's kind of continued at a moderate level. And that's normal for IPOs. They have to find the value. There's a lot of excitement. There's a lot of um, uh, uncertainty about the stock, but once it finally goes public, it starts to find its footing, and it takes a while, and that's why they have that lockup period. So we have a number
Hmm.
of clients who were into that one, either directly after it went public or even before it went public. But in that, the people who were before it went public, they're going to have some sort of lockup period, and so it's just something to make sure people understand that if
Yeah.
they're really committed to something, it's not the pump and dump idea, but it's a long term investment. They're going to be locked up for a while.
Yeah. And again, I should preface this conversation by when clients come to us with some of these semi liquid investment opportunities, whether they currently hold them or they're interested in holding them, our answer is not no, right? It's not a hard and fast no. But what we want to do is educate our clients to make sure that they understand the risks as well as the opportunities associated and where they fit within their portfolio. So there's some people that fall back on kind of some percentages of your portfolio is kind of a rough idea. And sure, those are maybe back of the napkin kind of assumptions, but every scenario is different because your cash needs are different, your investment goals are different, whatever's next coming up on the horizon for you is different. So when we're talking about semi-liquid investments, that conversation comes part and parcel with your long-term investment accounts and your cash accounts and your cash flow and et cetera, et cetera. So,
Yeah. Well,
okay,
and
so
is that
go ahead.
Yeah, to that comment, we've had a number of clients have really strong income even after they retire. They have investments that are producing really strong income, and so their normal day to day lifestyle expenses are generally covered, and that gives them a lot of freedom to use their investments for these types of things if they're interested in them and if they're going to add value to their overall plan. inevitably, all these conversations come with taxes and they come with kind of this legacy. What happens when the next generation inherits this? Are these
Yeah.
going to be efficient? And that's a great overlay that we see all the time. That there's some investments that we would generally say yes to, but for the specific plan, they get avoided because they're not going to have the tax or the legacy item that we anticipate. Others, that's the whole reason they're there. The whole reason where we have
Mhm.
these alternative non-liquid investments are for the sake of the tax benefits or even the legacy assets or how they're going to pass to the next generation. So as
Right.
Laura said, there's a lot of reasons why you might say yes or might say no, and it really, really depends on the individual.
Yep. And there's a whole fruit basket of different opportunities here. We won't be able to cover the list in its entirety, but there are a couple of things just to take away as some basic principles, which is know the investment opportunity that you're getting into. If there's contracts, if there's terms, and if you don't have time to review these, this is another great resource that you find in a financial advisory relationship. Make sure that you understand the ins and outs, the worst case scenarios, who makes the decisions, how they're paid, right? Because the devil is in the details on a lot of these investment opportunities. Some of them might be fantastic, but you certainly don't want to be the one that is getting a surprise at the end of the day or awaiting a big payout. We have a client who is in her 60s and maybe over a decade ago, as a new widow, was convinced to make a semi liquid investment and it tied up a sizable amount of money for her, hundreds of thousands of dollars for multiple years.
Yep.
And now she really can't instigate the pay back any sooner than what the fund manager is willing to do. Now she is getting paid back her capital plus a little bit of growth, but we're talking like 3% growth, right?
Yep.
And our opportunity as an advisor is not to go back and shame or guilt her in any way, but there are people out there really excited about new opportunities and they want to sell you on them. And guess what? They're good at convincing you that it's a good opportunity. Some of them might be, but you certainly want to look at it from all angles. And for her, cash flow is important, especially as she ages. And so, will she get her funds back? Yes. Could she have gotten higher performance in the market? Yes. She have utilized those funds in a different way? Yes. Did she feel like she was scammed? Right? That was an unwelcome surprise. And so now we get to kind of look at her portfolio differently as a result. Anyways,
Yep.
that was kind of a
Uh,
negative side of semi liquid.
no,
Maybe bring a
yeah.
positive
Yeah, but
perspective.
I love your comment of a key question for any of these is the person who's presenting this to you, whether it's a friend or whether it's a news source or something you read online, what's their incentive, right? Are they getting paid? Are they getting commission? And a lot of these non-liquid products, the people who create them then have to hire people to go out and stir up interest and sell them, and often they offer commissions. And not good or bad, but simply something to know is that if you say yes to this, is the person in front of you going to walk into a big paycheck? Well, that's in my mind, that's good to know. It's good to know what role they
Mhm.
play to you, if they're in sales or if they're really your advisor. And we've talked about this before in many episodes. We like to be shoulder to shoulder with our clients as their advisor. We don't take commissions. We don't work on that type of structure. It's a fee for services from our clients for the work we're doing for them. And the idea of that is that fiduciary role gives us indifference to what type of investments we look at. We want to find the best one that's going to fit what they need. So as we evaluate these, we're able to have that lens to say, does this fit where you're headed?
Mhm.
Converse to that, if somebody is simply selling this specific type of semi-liquid investment, they may not know someone's portfolio. They may not know where it fits in life. They just want to find someone who's willing to say yes to this. So that's a key one, is just understand the person on the other side of the table, what their interest is in this, and that will,
Mhm.
in my mind, either raise or lower your shields appropriately.
Mhm, mhm. So if you're interested by new investment opportunities or one comes your way, like you need to have a team, right? You need to have a thought partner. You need to have people in your life who are going to help you evaluate that scenario in light of your situation. And this is where the fiduciary role really shines bright, right? That really has your interest at heart. Tricord this year is actually partnering with a local commercial real estate entity that certifies different brokers and real estate agents, and some people would say that's kind of ironic, because when you come to a financial advisor, oftentimes they're not big advocates of real estate holdings because it means that you're taking funds from their investable account to invest in real estate. Now, this isn't always the case, But one of the things that Tricord likes to do is make sure that we're embracing real estate as a part of a well-diversified portfolio, and we're not placing any standard percentages in terms of the allocation within your portfolio, because it's different to everybody. Your interest, your expertise, again, your role within owning real estate, if you want to do property
Hmm.
management or be an investor like in a REIT, it plays a part in a well diversified portfolio. And we're not going to say no to it. But this is, again, where that fiduciary role really becomes front and center. And you want to listen for this in your advisor relationship. If an advisor is telling you no to an investor opportunity, I wonder why. Right? Does it benefit them if you don't take that investment opportunity? Right? And so some people call themselves a fiduciary, but you need to make sure that their actions are a part of it as well. So here at Tricord, we love that role. We love being fiduciaries, holding our clients' interest first and being able to evaluate together with them all the available opportunities and what interest them.
If you're looking to move at the speed of that confidence to say, we have a thought partner, we have someone who will walk through these new ideas, these new thoughts. The world's changing, right? And movers and
Yep.
shakers are changing with it. So we love to be that thought
Yep.
partner to walk through with people.
All right. Thanks for listening. We have a few more things to let you know about before we go. Podcast reviews really help us to serve more people and get this information into the hands of the people who need it. Please leave us a review. Even if it's not 5 stars, we welcome the feedback.
And we invite you to let us know what topics you would like to hear more about, or what would benefit the people in your life who you're closest to. We have more resources online. Those resources are designed to help you share this great information easily with people in your life. To access those resources, please visit tricordadvisors.com.
Often we hear from clients that they wish they had talked to us sooner. If that's you, we'd be thrilled to see how financial planning can benefit your life. Email us at contact@tricordadvisors.com or simply click on the link in the show notes.
This show was produced by Graham Gardner at Model FA. Find out more about how to create a podcast for your financial planning business by visiting modelfa.com. We love creating content that's useful, resourceful, and maybe even a little entertaining. We want to make this mega universe of financial topics and advice applicable and helpful to your life.
Remember, at Tricord Advisors, we are your future's best ally.